Hello financial fans, welcome back to another stock analysis. Today we'll be covering Medifast, stock ticker MED. Medifast sells health and weight loss products in the United States. Currently they're sitting at a market cap of 1.25 billion and they had a revenue in 2021 of 1.53 billion. Their dividend yield is currently sitting at 5.72%. Currently Medifast is undergoing some customer retention headwinds. Ex-customers have said that this is caused by inflation. To evaluate the company, we'll be using a margin of safety. This will be determined on the financial ratios and financial health that we'll get to in just a moment. We'll calculate this margin of safety by using a scale. When we're using 4 colors in our scale, the bright red means 5% added to our margin of safety, orange means no change to our margin of safety, light green means a 5% reduction in our margin of safety, and bright green means a 10% reduction. When we're using 3 colors in our scale, bright red means 10% added to the margin of safety, again orange means no addition, and bright green means 5% reduction on our margin of safety. The first financial ratios that we'll be looking at is the EBIT growth and the margin growth. As you can see, the EBIT has been growing steadily over the past years. It has grown from 34 million to 216 million in 2021. The average growth over this period has been 46%. Looking at our scale, this means we reduce the margin of safety by 10%. The margin has also been growing. Together with a growing revenue, also the EBIT has been growing. The average growth during this period was just under 2%. Sorry, just under 3%. This means, again, it's in the bright green section of our scale, meaning a 5% reduction on our margin of safety. The next two ratios that we'll be looking at is the dividend growth and the payout ratio. The dividend has been growing massively over the past years. It went from 40 cents a share yearly to close to $6 a share yearly. This means the annual dividend growth was 60%. Looking at our scale, this is far in the bright green, meaning a 10% reduction of a margin of safety. The payout ratio of Medifast is currently sitting at just over 48%. This means no change in margin of safety. The excess money that Medifast is making is going to return the earnings. The last two ratios that we'll be covering are the debt to equity and the return on invested capital. As you can see, the shareholders' equity is far larger than the liabilities that Medifast is currently bearing. The ratio here is 0.16, which means, looking at our scale, a 5% reduction in the margin of safety. The current return of invested capital for Medifast is currently sitting at a whopping 132%, which means a 10% reduction on our margin of safety. Let's go look at the valuation models next and see what the company is actually worth. The first valuation model that we'll be looking at is the discounted cash flow model. I have imported a free cash flow going from 2012 to 2021. The average growth during these years was 18% on average. To calculate the lifetime expected growth and the future free cash flow of Medifast, I've gone with 30% of the average, coming at 5.5%. With this 5.5%, we can determine the future free cash flow up until 2030 and determine the terminal year of Medifast. In this calculation, we'll be using a perpetual growth rate of 3% and a discount rate of 8.5%. Calculating all of the present value free cash flows, we get a sum of free cash flow of just under $1.3 billion. To get our equity value, we'll be adding the cash and equivalents and subtracting the debt. Doing this, we get an equity value of $1.35 billion. To get our discounted cash flow price per share, we just have to divide it by the shares outstanding, which is currently sitting at just under 11 million shares. Then the discounted cash flow price per share will be determined, which is almost $124. With the current price of $111.79, we get an upside of $12.11, which is just under 11% upside. The next model that we'll be using is the dividend discount model. I have imported the dividend payouts of Medifast from 4 years ago to the current year. The growth rate has been a staggering 37% on average. Because we're doing an expectation of the growth rate in the future, in the lifetime future of Medifast, I've gone with only 10% of the growth rate, coming in at 3.7%. In this calculation, we'll also once again be using the discount rate of 8.5%. Out of this model, we get a discounted dividend price per share at $141.78. With again the current price of $111.79, our upside is just under $30, which is almost 27% upside. The last valuation model that we'll be using is the multiple valuation. By looking at peers, their stock price, and their earnings per share, we get a PE. Then we'll take the average PE of the peers and multiply it by the earnings per share that Medifast is generating. As we can see, the fair value is very low here, at $56.47. This is because the PE ratios of the peers of Medifast are very much lower. Hence, we get a downside of $55.33, which is almost a 50% downside. Let's look at the final valuation of Medifast. Coming to our final overview, we can see we have imported the discounted cash flow valuation, the discounted dividend valuation, and the multiple valuation. Together, these come in at an average of $107.38. We have also calculated our margin of safety, which is minus 5%, meaning we'll actually want to pay more to buy the stock. As we can see here, these have been imported from the ratios and the financial health that we have talked about earlier. Hereby, the fair value is $112.75. With the current price of $111.76, the upside is just under 1%. If you want to ignore all of the financial health ratios and want to put in your own margin of safety, you can just put it there, and then the upside would actually be a downside at almost 33%. I hope you enjoyed this video and learned something. If you want to see another company, please let me know in the comments. Thanks for watching.